Hello everyone, this is Dr. Trussell, and normally we do this in class, but given that they canceled the first class, I decided to make a video to review the accounting cycle. So please go through this video before the homework is due, which is on Wednesday. So go through the video and then go and see how well you do at the homework for the accounting cycle review. The purpose of this is just to make sure that you understand how the accounting cycle works. It's really back from chapter 3 of the textbooks if you want to go back and review that. So I look forward to having you this semester, and I'll see you soon. So what we're going to do is review and apply the 8 steps in the accounting processing cycle from chapter 2. Sorry, I said 3 earlier. Chapter 2 of the textbook. The first 4 steps you're going to see in a second here are completed during the period. When are the others done? Well, what do we mean by the accounting period? What's the typical length of time? And by the way, normally these questions, which I call activities, so chapter activities, that you're going to complete ahead of time, and then we'll go through them in class. But since we missed that first class, I'm going to go through them with you online here. So the accounting period is typically what length of time? Well, it's either a month, a quarter, or a year. All companies have at least yearly accounting periods. Some companies, like publicly traded companies, always would have quarterly accounting periods, and then some, mainly for internal purposes, will have monthly accounting periods. And the last 4 steps are completed at the end of the accounting period. So let's review the steps in the accounting cycle and when is each one done. So basically you're required to put in when each one is, what's the order that we complete them. The first one is right here, and that is to obtain information about transactions from source documents. You're trying to figure out what is the transaction, what happened, what occurred. You can't do anything till you figure that out. The second one is to analyze the transaction. So we're using that step to figure out what accounts are impacted. So you're going to figure out which accounts, and remember, in double entry accounting, at least 2 accounts are impacted. So to analyze the transaction, you would say which at least 2 accounts are affected and how were they affected. Were they increased, were they decreased, and by how much? And do those increases and decreases translate into debits or credits? The third one is to record the transaction in the journal. Once you've decided what accounts are impacted, you're now ready to record them into the journal. And then once you've recorded them, you post them from the journal to the ledger down here. And then, so those 4 are done during the accounting period. Now the others are done at the end of the accounting period, and number 5 would be right here, to prepare an unadjusted trial balance. That's just a listing of the accounts in debit and credit formats at the end of the accounting period according to their balance as either debit or credit before you've made any adjustments. Then we're ready to, down here, number 6 is to record the adjusting entries and post them to the ledger accounts or the T accounts. Record the adjusting entries. Adjusting entries are those entries we make at the end of the accounting period to correct or update the accounts. And then number 7 is to prepare an adjusted trial balance. Because we've made all the adjustments, we're going to now make another trial balance. And then number 8 is to prepare the financial statements. Now there are other things that we do after that point. I just wanted to get the first 8, but also you would have number 9, which I don't have listed here, which would be to prepare and post the closing entries. And then we also prepare what's called a post-closing trial balance. So yet another trial balance. But so these are the major steps in the accounting cycle. We do them every accounting period. And it's very important to understand what are the 5 primary financial statements and what does each one tell you about a company. You have to absolutely know these things. Number 1 is the income statement. What does that tell you? It tells you the profits of the company. Revenues minus expenses tells you the profits. And what period? A period of time. Not the end of the period, but for a period of time. The second is the statement of comprehensive income. It's a statement that a lot of people get confused about, but it includes the income statement plus other items that are gains and losses that are like income statement accounts, but the FASB does not allow us to recognize them on the income statement. You'll see as we go through the semester, there are several gains and losses that you would think would go up here in the income statement because that's where our revenues and gains and losses and expenses go. But the FASB says no, they're not to be considered as income, so we put them down here under comprehensive income. The next one is the balance sheet, and the balance sheet includes assets, liabilities, and stockholders' equity. That's where we get that formula, right? Assets equal what? Liabilities plus, sorry, I'm writing with the mouse here, stockholders' equity at a point in time, not for a period, one point in time, the end of the accounting period. Then we have the statement of cash flows, which shows our cash flowing in and out of the company. What are our sources and uses of cash? And there are 3 categories on there. They're operating activities, investing activities, and financing activities, all for the period, entire period. Then finally, we have the statement of stockholders' equity. And the statement of stockholders' equity shows changes from last year to the current year. How did stockholders' equity accounts? What happened to retained earnings? What happened to common stock? What happened to preferred stock? How did they change throughout the period? The ones that we focus primarily on in this course are the income statement and the balance sheet. Not that the other ones aren't important. We also have an entire chapter on the statement of cash flows, and we have an entire chapter on stockholders' equity, which includes that statement. Statement of comprehensive income is kind of infused throughout the course when we have various chapters like the pension chapter that deals with comprehensive income. The next important thing to remember are the types of accounts. For example, we have assets. Assets, the official definition, probable future economic benefits obtained or controlled by a particular entity as a result of past transactions or events. Examples are cash, accounts receivables, inventory, property, plant, and equipment, investments, that kind of thing. All right, so those are all assets. What are they? Probable economic benefits that we're going to get in the future. But sort of a working definition are things that we own. Things that we own. Liabilities are probable future sacrifices. Notice the difference. Sacrifices of economic benefits means we're going to give up assets in the future arising from present obligations of a particular entity to transfer or provide services to other entities in the future as a result of past transactions or events. It's a very long definition, but sort of our working definition are things that we owe. What do we owe somebody? Those are our debts. So we have examples: accounts payable, notes payable, wages payable, interest payable, taxes payable, bonds payable. All those payables go into there. Then we have shareholders' equity is our next type of account, and that's the residual interest to the assets after we deduct out the company's liabilities. Because remember, we said assets equal liabilities plus stockholders' equity. What does that mean? It also means that I'll move the liabilities to the other side. Assets minus liabilities equals stockholders' equity. I just subtracted the liabilities from both sides. And so you'll see after we deduct our liabilities, it's the assets left over. Sometimes they call that net assets. So what goes under that category of accounts? Common stock, preferred stock, retained earnings, paid-in capital, that kind of stuff. Revenues and gains. Now those are two different types of accounts, but they're very similar, so I tend to throw them together. They are inflows or other enhancements of assets or settlements of liabilities from delivering or producing goods, rendering services, or other activities that constitute an entity's ongoing major or central operations. Notes gains are similar, but typically not from our central operations. That's kind of what makes them distinguished. Example are sales revenue, interest revenue, gain on sale of equipment. You don't always sell your equipment, so it's not central to your operations. So those primarily we think of providing a service or delivering a good that results in a revenue. Then expenses and losses, outflows or other using up of assets or incurrences of liabilities during a period from delivering or producing goods, that should be goods, rendering services, or other activities that constitute the entity's ongoing major central operations. Note losses are similar, but not from central operations. So we have rent expense, utility expense, salaries expense, depreciation expense, all those types of expenses that we think about go into that category. So those are our 5 types. So we have assets, liabilities, stockholders' equity, revenue/gains, expenses/losses. Let's refresh the debit and credit rules. Of those 5 account types, which one increase by debits and decrease by credits? So we have 5 accounts. Which ones are increased with debits and decrease with credits? Only assets and expense losses do that. Then we have the other accounts that flip. They're increased with credits and decrease with debits. The other 3. So if you can remember, the assets and expenses are increased with debits, then the other 3 are increased with credits. So that's it. Those are the rules. And remember, the debit is just the left side of the account, and the credit is simply the right side of the account. Debit and credit themselves does not mean increase and decrease. It just means left and right of an account. So if you think of a T account, all right, the T account, there's a left side, there's a right side. The left side just means debits, and we normally abbreviate debits DR, and the right side is credit, which we abbreviate CR. So assets and expenses are increased on the debit side, where the other 3 are increased on the credit side. Let's talk about adjusting entries. Of Chapter 2, that's the main part where a lot of people get kind of messed up a little bit, so I want to take some time looking at adjusting entries. What are the 3 categories of adjusting entries, and let's look at examples of each. Well, the first type are what we call prepayments or deferrals. That would include things like prepaid rent, supplies, deferred or unearned rent revenue, depreciation expense, etc. Those are, in essence, we paid in advance, and so we don't have the expense yet because they haven't been used in providing a service. So prepaid rent, you pay the rent in advance, and then later on you get to use the building. So supplies, you buy the supplies now, and then you'll use them up later. So you're deferring the recognition of the expense until a future period. And then accruals are kind of opposite of that. Interest payable, interest receivable. That means that the expense has actually been incurred, but you hadn't paid for it yet with interest payable. Or the interest has been earned, but you haven't received it yet with interest receivable. So it's kind of the opposite of a prepayment. And then we have estimates. Now you'll notice that depreciation falls in both cases because depreciation is a deferral, but it's also an estimated expense, in that we're just kind of guessing or estimating what our expense is. And then bad debt expense, another example is warranty expense. Those are all estimated expenses. And reason why they're adjusting entries, because bad debt expense, for example, if you remember talking about bad debt expense, it is an estimate of the amount of accounts receivable that we're not going to collect in the next period. So we're estimating now what we're going to not collect in the next period. Well, let's go through an example of adjusting entries. Prepare the necessary adjusting entries at its year end of December 31st, 2016 for James Way Corporation for each of the following situations. No adjusting entries were recorded during the year, which is pretty typical. If you're just doing your period is a year, that you haven't made adjusting entries during the year. Number one, on December 20th, 2016, they received $4,000 payment from a customer for services to be rendered early in the next year. Service revenue is credited. Well, what's the problem with crediting service revenue? You haven't actually earned the revenue yet. So in essence, that's almost like a correction of an error, because if you record it as a service revenue, it's not really a service revenue. It's unearned revenue because you haven't earned it yet. So therefore, we have to debit service revenue to get it off of the books and credit deferred or unearned service revenue to recognize the fact that we haven't earned that revenue. The next one, December 1st, 2016, the company paid a local radio station $2,000 for 40 radio ads that were to be aired 20 per month throughout December and January. Prepaid advertising was debited. Example number two, the December 31st, 2016 adjusted trial balance for the Blue Boy Cheese Corporation presented below. Notice it's adjusted. We don't have to make any adjustments. Prepare an income statement for the year end December 31st, 2016 and a classified balance sheet as of. So this is the end of the period. This is for the year. So an income statement and balance sheet, and then we're to make the closing entries. Now the trial balance is normally set up already in our asset, liability, stockholders' equity. So here are our asset accounts, assets, and then here are our liability accounts, and then we have two stockholders' equities, and then we have one revenue account, and then we have several expense accounts. All right, so the revenues and expenses, get a different color here. Our revenues and expenses are going to go to the income statement, and our assets, liabilities, and stockholders' equity are going to go to the balance sheet. So here's the proper format for the income statement. Notice that we say the title of the company, the name of the statement, and the period covered for the year ended. We have our sales, cost of goods sold, sales minus cost of goods sold. So here's the proper format for the income statement. Notice that we say the title of the company, the name of the statement, and the period covered for the year ended. We have our sales, cost of goods sold, sales minus cost of goods sold. The second part of the balance sheet looks like this. There are current liabilities, which are those liabilities due within a year. This problem didn't have any non-current ones. Then we have stockholders' equity, common stock, and retained earnings. When you add the two types of accounts together, you're going to get your same thing as your asset. So that's your check. And where do we get the retained earnings? It is the beginning balance plus net income minus dividends, which this problem there were none, but that's how you get the ending balance. The final thing we had to do with the closing entries, and the closing entries, what we do is we close out all of our so-called temporary accounts. The temporary accounts are all of our income statement accounts, which will be revenues, gains, losses, and expenses. In this particular one, we only had one revenue account, and to zero or close it out, well, revenues have credit balances, so we had the debit to close it out against the income summary. And then expenses all have debit balances, so to close them out, we have to credit. So notice these are all credited, and then just add up all these numbers to give you our debit to the income summary. Now we have a balance in the income summary. If you look at the balance, we take this 800,000 minus the 699 gives us a credit balance of 101,000. So we need to close that out, and we do that by debiting the income summary and crediting retained earnings. That's the same 101,000 that was